And the way I would describe it now is that, with Bitcoin, it basically replaces the need for a central bank. It's this kind of core settlement ledger that if it were to become significantly large, it doesn't mean it replaces it today, but it means that the underlying ability is there to replace something like a central bank.
Lyn Alden's in-depth analysis of Bitcoin's evolving roles, the role of Bitcoin ETFs in the world asset market. She discusses the issues that Bitcoin faces, including tax issues, technological issues, and price volatility. She also discusses the potential opportunities that Bitcoin may present as its acceptance and popularity continue to rise. Big Bitcoin's value might skyrocket, according to Alden. He even speculates that by the final quarter of 2024, it may hit $100,000. This is because the market is maturing as Bitcoin ETFs grow more popular and more institutions are showing interest in Bitcoin. Alden, he or she contrasts Bitcoin with more conventional assets like coins and real estate, examining the future of Bitcoin's increasing significance and influence in the global financial system by discussing topics such as energy consumption and the continuous dispute between proof of work and proof of stake processes. Alden provides helpful information on why Bitcoin will be a significant asset in the future for both novice and seasoned investors.
Banks serve a purpose in different areas of life over time, right? And their roles has changed. In the earlier times, you'd have basically money changers or, Hawaladar networks. And so basically you'd have these kind of proto banks. And basically what banks do is they provide kind of abstraction, right? So if I want to send value to you or you want to send value to me, especially over long distances, how do we do it? Well, in kind of the older era, it was easier to transport and safer to transport notes that represent a certain amount of precious metal rather than the precious metal each time. And then especially once the telegraph became more and more ubiquitous in the later half of the 1800s, we could update ledgers, update value by going through these intermediaries. So people gravitate toward them because they were providing a service. They were basically an abstraction layer on top of the actual money. But then the problem is, and this is what I focus on in the book, is that the gap between transaction speeds, so all that banking layer, became really, really fast compared to the settlement speeds, the ability to actually send gold from, New York to London or whatever, and it's settled now. And so basically, as that gap grew, as we entered the telecommunications age, the early stage of it, we had this whole kind of virtual network of money moving around, and it's just claims moving around for gold that rarely ever moves. And that's a recipe for corruption. It's a recipe for very intense fractional reserve systems. It's a recipe for all sorts of problems. And so even in the late 1800s in the UK, for example, the system was levered 20 to 1. And that was when it was still working fine. That was kind of the classical golden age, the gold standard era. And yet under the surface, it was already highly levered. The way that I generally describe it is that they served a purpose, but that they caused issues along the way. And the way I would describe it now is that, with Bitcoin, it basically replaces the need for a central bank. It's this kind of core settlement ledger that if it were to become significantly large, it doesn't mean it replaces it today, but it means that the underlying ability is there to replace something like a central bank. And then I would say that banks would still exist in some form, just on the periphery. They're more optional, right? So we had this kind of situation over time where banks were on the periphery. They would provide certain services. They were optional. Then they gravitated toward being the literal center of the system. Like a dollar is a liability of the Federal Reserve. That's what a dollar is. That's what fiat currencies are. Literally, banks are the center of money now. And I think that we can gravitate back toward, no, like banks are not at the center of the system. They just provide services at the periphery of the system for those that want them. And I think that's in long term, that's healthier.
How long do you think we have before the US dollar is going to collapse? And what kind of signal we should be aware of?
I think probably years or decades, but it depends on what you mean by collapse. I mean, I visit Egypt every year and they go through periods of 30, 40% inflation. Um, they've never, in the kind of modern history, they've never gone through hyperinflation. Do we define that as having collapsed? Their money supply average is something like 20% growth per year. It's still functional. People are using it. It's not something you want to save value in. It causes all sorts of issues, but it's there. And I think the U.S. The dollar goes through a very long period before it even gets to that stage. Let alone if we were to define that stage as having collapsed. And I would define like Venezuela's currency as collapsed, but not Egypt's. And I would say that the U.S. has a lot of runway before it looks something like Egypt's currency. Basically, the kind of the variables at play here are the U.S. has growing debts and deficits, and we have a structural trade deficit, and that's all bad for the currency. And on the other side of that, it's got two really big things going for it that are related. One is it's the most liquid and valued currency in the world, so it's the most saleable good among fiat currencies in the world. And so it's what a lot of companies and governments denominate contracts in, provide international financing in, and when you exchange two currencies, 90% of the time, the way you do it is you exchange one for the dollar and then the dollar for the other one. That's where you get the most liquid markets. And so it's entrenched there. And then the other point of that is that the majority of international debts are denominated in dollars. So there's over 13 trillion.
When discussing the origin of Bitcoin, Lyn Alden notes that it began as a collectible and was used to fund WikiLeaks. However, because to issues with low payment in industrialized nations and transaction charges that made it unfeasible for everyday use, it failed to gain traction as a currency. But rather, because of its scarcity, Bitcoin gained popularity as a store of value. Because big assets frequently develop ETFs to make them more accessible, the argument for Bitcoin ETFs has been stronger as a result. The introduction of Bitcoin ETFs may result in even greater acceptance and incorporation into everyday life, as a significant price increase is anticipated before the year is over. ETFs are probably going to play a big role in facilitating access to Bitcoin for traditional brokerages and retirement plans. They will serve as a conduit between the conventional financial system and the cryptocurrency sector. Let's examine some further conversation snippets.
In dollar denominated debts, plus all sorts of like swaps and options and other layers on top of that, but just literally securities and loans over 13 trillion. And all of that represents inflexible demand for dollars, right? So that's more than the monetary base of dollars. There's more dollars owed to international creditors by various countries and their corporations than dollars exist. So there's more demand than there are dollars, at least base dollars, and nearly as much as broad dollars. And so that's inflexible demand. And so I think that Gordian knot has a very long time to unravel. And I think it's a long process. I don't think anything stops this train anytime, in the next several years.
I mean, what's the way out here? What do you think we should do?
I think basically you have parallel systems, right? So one is going through entropy, meaning it's getting less orderly over time, and it's kind of past its heyday, and now it's got all sorts of issues, but it's still got all those entrenched massive network effects. And then you have rising new technology, new ecosystems, new enthusiasm, and the technology is generally better than it was any given 5-year period ago. And so I think basically the what you can do, depending on what level you're at, is just you can opt out, or at least you can have a foot in both worlds. You can say I'll use the incumbent system for when I have to, and for kind of local, most people have a bank account and they use it, but I'm going to kind of take that side with a grain of salt because it's only going in one weakening direction, and I'm going to embrace this newer thing, which is Bitcoin, or in some countries also stable coins, but basically really the two applications of this technology that have had really good product market fit, and say I'm going to go into this world instead, and I'm going to store my value in something that isn't diluted by any sort of central entity. And I think and then if you're a corporation or a government, you can do similar. Generally speaking, the smaller the entity, the fewer decision makers, and the larger the entity, the more decision makers, with some exceptions. Um, and you just kind of opt out, and you protect yourself. And I think there's a very long process of more and more people doing it. And then along the way, what we're doing is we're testing this new system. We're saying, how secure is it really? How robust is it really? What needs to be improved about it, either on, say, the base layer or the various layers that click on top of it and enhance it. How can we make this better and truly replace, as many components as possible of the prior entropic system.
According to Bitfinex analysts, the decline to the $6,000 support zone and other technical considerations are a clear sign that volatility risks have reduced the price surge to $66,667, which swiftly subsided as worries about the U.S. economy and geopolitical tension in the Middle East subdued it. Market optimism, Bitcoin drops from its highest point to the O, indicating a long market mindset, and how leveraged holdings became a factor below $65,000. Bitfinex reports that almost $450 million in long positions were liquidated during the dip. Despite the fall, Bitfinex is still upbeat, pointing to strong US labor data and anticipating a November rate cut by the Fed. Although they pointed out that spot purchasing activity has returned in response to Bitcoin's rebound to $62,500, they advise against making firm judgments about short-term patterns. For hints on Bitcoin's next move, they advise keeping an eye on early week trading periods, particularly in the US.